History shows us that financial markets rarely signal a change in direction politely. Instead, they communicate through a sudden stop. On July 28, 2026, the South Korean stock market hit a wall. The Kospi index plummeted nearly 11% in a single session. The sell-off was so violent that it triggered a mandatory market-wide trading halt for 20 minutes. South Korea's domestic economy had not collapsed. Instead, the index was carrying an enormous vulnerability: heavy concentration in two companies, Samsung and SK Hynix. Both are vital suppliers of the advanced memory chips required for artificial intelligence. When investors decided those chipmakers were overvalued, the entire national index went down with them. Sovereign equity markets have effectively become leveraged derivatives of global AI sentiment. The panic on the exchange floor answered a specific question. The market is no longer debating whether artificial intelligence matters. It is aggressively questioning who actually captures the money. In the 1840s, a massive railway expansion permanently upgraded British shipping logistics. Decades later, the build-out of fiber-optic cables gave the world high-speed internet. In both cases, the infrastructure delivered vast economic utility, and in both cases, the investors who financed the initial build-out went bankrupt. To navigate a technological boom, you have to separate the utility of the tool from the financial structure paying for it. A technology can succeed while the assets funding it disappoint. We can map where profits settle by looking at the AI stack. It descends from software applications at the surface down to the physical bedrock. Tracing an investment dollar from the top down to this foundation reveals the real economic choke points. Buying the most advanced capability is often a trap. Survival means understanding the hidden flow of capital. We start at the model layer. This is the most culturally visible territory, home to frontier builders like OpenAI and Anthropic, and the most financially precarious. Look at the capital commitments. By 2028, OpenAI's computing expenditure will hit $121 billion. Anthropic projects an annualized revenue of $30 billion. They deploy opposite strategies. Anthropic ties 85% of revenue to enterprise customers, while 95% of OpenAI's users pay nothing. But both face the same defining structural paradox. The companies building the models do not own the infrastructure required to run them. To build these products, they rent massive compute clusters from hyperscalers like Microsoft, Amazon, and Google. These cloud providers are simultaneously the model builders' investors, their largest customers, and their direct competitors. Developing the most expensive software product in history on rented servers leaves builders at the mercy of suppliers. Moving one layer down to hyperscalers reveals the financial engine keeping the ecosystem afloat, the AI capital loop. Institutional investors purchase hyperscaler debt. This borrowed cash, roughly $450 billion, is deployed to build data centers, driving billions to NVIDIA. These suppliers then invest back into model builders via compute credits, forcing them to spend that investment right back on the hyperscaler servers. This loop prices companies for perpetual, flawless expansion. NVIDIA's valuation demands its competitive dominance remains uncontested, and that capital expenditures continue accelerating without pause. It is a tightly wound, leveraged system. If a single hyperscaler pulls back on spending, the entire debt-financed superstructure faces a rapid repricing. Digital ambition collides with rigid physical constraints. At the bottom of the stack, AI is bounded by concrete and physical supply chains.
Advanced GPUs require high bandwidth memory. Producing these specialized components requires extreme manufacturing precision inside multi-billion-dollar fabrication plants. High bandwidth memory requires 3 times the raw wafer capacity of traditional memory to produce. This creates an unyielding physical choke point. You cannot solve a fabrication shortage overnight simply by throwing more capital at it. The constraints extend to the power grid. AI data centers have gigawatt demands, requiring localized transmission that stretches planning systems to their breaking point. Then there is the human bottleneck. A data center cannot operate without the mid-level electricians required to physically wire the facility, a labor pool currently facing a severe national shortage. In a purely digital arms race, the ultimate economic winners are often the legacy companies controlling these unscalable physical choke points. With trillions of dollars committed to the physical and financial build-out, the macroeconomic question becomes unavoidable. Is this generating proportional economic returns in the real economy today? Economists track this discrepancy using a concept called the productivity J-curve. The left side of the curve drops below the baseline. This represents the immediate reality for most businesses adopting new technology. They suffer heavy initial capital costs, difficult workflow redesigns, and expensive data governance overhauls that yield negative immediate profit. Financial markets are currently pricing in the right side of the curve, the massive future profits, before the broader economy has actually survived the costly integration phase on the left. The primary wildcard that could break those market expectations is the divergence created by open-source competitors, like DeepSeek. If highly capable intelligence becomes dramatically cheaper to produce and deploy, it commoditizes the product. That price collapse destroys the massive profit margins required to pay off the $120 billion compute clusters currently being built by the incumbents. Technological capability does not guarantee profit. Radically cheaper AI expands global utility, but it decimates the exact business models reliant on selling exclusive, expensive compute. The speculative boom will end. A settled, permanent economic reality will take its place. Investors are left choosing between two outcomes: a bull case where delayed software integration finally yields massive enterprise gains, or a bear case where the infrastructure layer suffers a structural debt failure. We can determine who survives either scenario using a value capture framework. At the foundation, enduring value accrues to those controlling the physical bottlenecks: the energy grid, specialized labor, and raw manufacturing capacity. Moving up, value holds steady for incumbents with massive existing cash flows. They have the balance sheets to absorb the heavy losses of the J-curve integration period without requiring constant external debt. Above that are the distribution networks. Companies with existing captive user bases will capture the value of new applications simply because they do not have to pay customer acquisition costs to distribute them. For the rest of the ecosystem, the raw intelligence models at the very top, survival means fighting a brutal race to the bottom on pricing. The artificial intelligence stack will reshape the global economy. But do not ask if the technology works. Ask who will actually be left holding a valuable asset once the extraordinary installation phase is over and the economics of intelligence become ordinary.